Ladies and gentlemen, we also have senior industry experts joining us this morning for this session. Shri C.S. Shetty, Chairman, State Bank of India. Welcome to you. Mr. Ashish Kumar Chauhan, Managing Director and CEO, National Stock Exchange. A warm welcome to you, sir. And the moderator of the panel discussion of the session, Madam Ira Dugal, India Financial News Editor, Reuters. Request you, ma'am, to please join us. I believe she'll be here shortly. So, ladies and gentlemen, over the last decade, India has emerged as a beacon of economic growth, showcasing an impressive average annual growth rate of around 7% despite global headwinds due to geopolitical factors, increased inflation and the like. As India aspires to become the third largest economy by 2030 from the fifth largest economy presently, the role of financial sector and foreign investments, both FDIs and FIIs, will remain extremely important. The key objective of the summit is to identify and explore various sources of funding for sectoral and overall growth of the economy by bringing together key stakeholders at this common platform. With those words, I call upon Mr. Chandrajit Banerjee, Director, CII, for the introductory remarks. Sir.
A very good morning, ladies and gentlemen, and it's a proud privilege to welcome each one of you to this very well-timed Financing Summit 3.0, preparing for Viksit Bharat. And it's a singular honor, if I may say, to have Dr. V Ananth Nageshwaran, the Chief Economic Advisor, to have led this summit, given so much of time during the last few months and weeks to see to it that we shape the content the way it is today, and to see such high quality presence in this room. It was his idea to have this deliberation and discussion in Mumbai. So indeed, a pleasure to have worked with him. And of course, as you heard, Mr. Sanjeev Bajaj. Sanjeev's been co-chairing the summit with Dr. Nageshwaran, which has led to such a very good output in terms of the content and participation. So welcome Dr. Ananth Nageshwaran, welcome Sanjeev. Thanks for being here. And I would really like to also welcome each one of you who are in this room. This is a very hand-picked, if I may say, audience. We are indeed privileged to have such great leaders from the financial sector and some of the best minds. And incidentally, I was telling Mr. Shetty, the chairman of the SBI, that this is your first public function for CII after assuming this phenomenal role. So congratulations, and I'm hoping to see you many more times at the CII event. But a very old friend, Ashish Kumar Chauhan. Ashish, has always been a pleasure working with you on many areas. And Ira, who I was asking whether her questions would be more too difficult or to answer, I request you to make it very difficult for some of these panelists led by the Chief Economic Advisor. Ladies and gentlemen, if you see the forum's title, the way we have done it is, of course, Viksit Bharat, and we look forward to the Chief Economic Advisor's inputs on whether India's financial sector is geared up to support this and look at sustained level of high growth and what's the role, I mean, his perspective and how he sees from his prism as to what's happening. And as I was saying, one of the things that the Chief Economic Advisors have been doing, and if I can say it in 3 C's, one is his collaboration, as I have seen, with industry and with many sectors of the economy. The way he has collaborated to get views, ideas, inputs, and then sort of deliberate on it, always open to idea. And the second part, which is sometimes been difficult for us to navigate, are the challenges that he has thrown to the industry. From time to time saying that why is this not being done, and why do we think in spite that certain things have not moved. But the third thing, the third C, which I've seen in him, which has really bolstered much of what's happening, is his confidence on the Indian economy, his confidence on the various stakeholders, his confidence on Indian business. While he has, if I can use a fourth C, which is that he is a crossover from business to government, and from the private to public service. But his brilliant mind of economics and his rich experience in key economic policy areas would today, of course, be of great value as we take the couple of days today and tomorrow forward. So I will just really like to stop here, because this particular summit, which is, as we have said, the Financial Summit 3.0, we would deliberate, discuss, and at the end of the 2 days, come out with, as I was talking to some of our leading speakers and the co-chairs, not just come out with recommendations, but also keep some questions alive for further deliberations in the times to come. I'm actually also very happy to see, as I was speaking, some of our friends from the consulate generals to be present here, and the consul generals. I really appreciate that. So, ladies and gentlemen, once again, welcome to this summit. Thank you.
Thank you, Mr. Banerjee, for the initial remarks. I will now invite Dr. V Ananth Nageshwaran, Chief Economic Advisor to the Government of India, for his presentation.
Yeah. For moving forward, right, for going back.
I know.
Okay.
Thank you. Good morning to my fellow panelists on the dais, and good morning, ladies and gentlemen. We have gathered here for a conference that deals with the crucial and pivotal role the financial sector could and should play in ensuring the country's sustained and sustainable development. This is not just a topic for discussion, but a call to action for all of us. All of you assembled here have a very crucial role to play in this conference. The comprehensive schedule is before you, covering all angles and considerations by which the financial sector can be a valuable aid to the real economy. Your insights and contributions are very eagerly anticipated, and I look forward to the deliberations as you are. I thank the CII for organizing this event. It is very timely, and thank you for inviting me to co-chair the conference. I look forward to a lot of learning. Before I proceed further with the substance of my remarks, I would like to state that these are my personal views and not that of the Government of India. I want to take a step back or step higher from looking at the specifics of the financial sector's role in the macroeconomy. And I would like to invite the audience to journey back with me to the years before and after the global financial crisis of 2008. Time erases memories and habits return, mostly bad ones. Notwithstanding the lessons available from history, most of us insist on repeating the mistakes ourselves. Our policy models and mental models must retain the memory of financial follies committed by others, because we can do better than repeating them. This speech, therefore, is a small attempt at minimizing the chances of those happening in our country. The Indian financial sector is poised at an important turnpike moment. The dominance of banking support to credit is being reduced and replaced by the financial sector, both with its products and participants. This is a long-awaited and welcome development for a country that aspires to be a developed nation by 2047. The challenge is to ensure that the sector grows in size and importance. As it does so, that it avoids the mistake that their counterparts in many advanced economies have committed over the years and continue to do so. Therefore, I'll confine my remarks to what we need to avoid doing rather than spell out what we ought to be doing. The rest of the conference will take care of the latter aspect. First, it is important to remember the financial sector shoulders a much higher responsibility than other sectors. The big difference between the financial sector and other sectors is that the consequences of what happens in this sector reverberate throughout the economy and beyond, carrying therefore a significant weight of responsibility on its shoulders. We know that when it comes to trade, globalization has slowed or is in the process of slowing, but global capital flows are going strong. As you can see here, the global merchandise trade volume growth used to be between 5 and 10% or even 15%, coming down to below 5% and now trying to stay above the zero line. However, if you look at the portfolio flows to emerging economies, while it might have dipped during the pandemic time, by and large, and also because of higher interest rates in the US and developed countries in the last couple of years, by and large, capital flows have not really seen the secular decline that we are seeing in trade flows. Global finance continues to dominate. Global credit rating dominates. But actions, fiscal, financial, and monetary policy decisions are local. Recognizing this incongruence or non-compatibility is important. Therefore, building resilience and domestic strength matter to us. Equally, retaining policy autonomy and space to insulate the economy from the vagaries of global capital flows is critical. As a country that runs a modest current account deficit, India relies on global capital flows. But India has one of the brightest global economic growth prospects. It is up to us to sustain it, and it is also up to us to use that to our advantage in carving out policy space for ourselves. In short, the country has to find and treat the fine balance between national imperatives and investor interests or preferences. Of course, it also means becoming a global agenda setter rather than an agenda taker. That will be a good thing. While some actions can be initiated now, such as, for example, an Indian entity making the effort to become a global credit rating agency, the outcome and the impact will take much longer to materialize. It is also largely endogenous. That is, our economic growth, economic size, and economic clout will influence our ability to become a global agenda setter, and that in turn will favorably impact our economic performance. We have to work on both, therefore, simultaneously. But agenda setting aspirations cannot run ahead of acquiring economic strength, size, heft, and vitality. The advantage of being a global agenda setter is evident in the case of the United States. The US ran fiscal surpluses in the last 4 years of the last millennium. It continued a bit in 2001 as well. Since then, fiscal deficits have been the norm. And in the last 4 years, fiscal deficits have topped 6% of GDP. However, the 10-year Treasury yield then was 6.4% in 2000, and now it is below 4%. What has driven the bond yield is not, therefore, fiscal deficits or government debt, but the Fed's monetary policy and market expectations. That is why the Chicago Fed National Financial Conditions Index is what it was in 2017. For the most part, in the last 30 years, financial conditions have remained easy and accommodative in the United States. In other words, what you are seeing on the right side of this chart, the tightening of monetary policy undertaken since 2022 is not seen in the Financial Conditions Index. Financial markets, therefore, are not the most reliable barometer of risk and reward. If they are not, they cannot be trusted to direct available savings to its most efficient applications. There is a secondary tendency related to that towards short-termism, narrower horizons, and investment windows in markets today. I remember reading in a World Economic Forum post that in the United States in 1970, companies included in the S&P 500 had an average tenure of 35 years. By 2018, the average tenure was down to 20 years, and by 2030, it is expected to fall below 15 years. That is also now reflected in the investors' holding periods, which is now considered to be below 1 year, probably close to 6 months. To be sure, there are long-term investors whose horizons stretch to several years, but the vast majority of investors today have much shorter horizons. Evidence from markets in advanced countries suggests that the probability of earning positive investment returns increases with the horizon. The shorter the horizon, the probability of losses increases, and the size of those losses also increase. This is far truer for derivative instruments than it is for underlying assets. Indeed, shorter horizons and more active trading have immensely benefited financial intermediaries. In the 3 years between FY20 and FY23, corporate profits before tax in India went up nearly 4 times. But excluding the financial sector, those profits rose only 3 times. Evidence from the global financial crisis of 2008 is that when the financial sector is in excessively robust health, the health of the rest of the economy becomes more fragile. India's stock market capitalization is around 140% of GDP. The record profitability of the Indian financial sector and high levels of market capitalization, or the ratio of market capitalization to GDP, give rise to another phenomena which deserves closer examination. When the market becomes bigger than the economy, it is natural, but not necessarily reasonable, that the considerations and priorities of the market dominate the public discourse and also influence the policy discourse. I am referring to the phenomenon called financialization, or the financial market dominance of policy and macroeconomic outcomes. In brief, financialization is the dominance of financial market expectations, trends, and importantly, interest in public policy and macroeconomic outcomes. As India looks ahead to 2047 with optimism and hope, this is something it has to avoid, because the consequences of such financialization is there for all to see in the developed world. Unprecedented levels of public and private sector debt, some visible to regulators and some not. Economic growth dependent on continued increase in asset prices to offset the leverage that have built up, and hence a massive surge in inequality. India must be wary of these outcomes and avoid this trap. Developed countries are encountering these challenges after they have become materially prosperous. Per capita, India is just about stepping into the lower middle income category. Therefore, as we deliberate on preparing our financial system to support our economic aspirations, India can ill afford the financialization and its ramifications that afflict advanced societies. In other words, we cannot afford to let the tail wag the dog. In a paper that they wrote in 2012, Professors Stephen Shetty and Karubi wrote that the relationship between the financial sector and productivity was inverted U-shaped. Their interpretation was that because the financial sector competed with the rest of the economy for scarce resources, financial booms were not, in general, growth enhancing. Ensuring that the dog is always ahead of the tail entails having a proper policy approach to financial innovations and compensation in the financial sector. Both are interlinked. In 2012, in the aftermath of the global financial crisis, Professor Eric Posner of the University of Chicago proposed a financial products authority along the lines of the Federal Drug Administration in the United States for approving financial innovations. He hoped that such an authority would take a net benefit cost approach to financial innovations as the FDA does to drugs. The crucial test is whether a financial innovation, product or process, advances the efficiency and the effectiveness of the savings investment intermediation function of the capital markets. A close look at the financial or compensation incentives of those who propose or sponsor the innovation will also help decide whether the financial innovation is a net positive contributor to social and economic welfare in the country. In his landmark speech delivered in July 2008 in Manchester, Dr. Y.V. Reddy, the former Governor of the Reserve Bank of India, remarked, and I quote, "In particular, it may be argued that the incentive frameworks for financial intermediaries appear to be disproportionate to their conceivable contribution to the economy. The arguments in favor of persevering with financial innovation and urging regulators to continue to give priority to facilitate innovations should be viewed in this context." Unquote. I would add that the consideration of crypto assets as investment option and the recent discussion in India on retail participation in derivatives must consider Dr. Reddy's wise words and Professor Posner's proposal. I think I'm running out of time just as well. For the most part, India has charted its own path in social, cultural, religious, and economic affairs over the centuries. It has to have the courage of conviction and awareness of the socio-economic context of a low, middle income, and aspiring large population to repeat that feat with respect to the financial sector. Success in this endeavor, which requires us to learn from the mistakes of others, will enable India to be a true Vishwaguru to emerging and advanced economies in ensuring that the financial sector remains the servant of the real economy. Thank you very much.
Thank you. Thank you very much. That was really a great exposition and really provokes a large number of thoughts. And I'll keep that for later so that we can get as many people in for this discussion. But before I turn to Ira Dugal, may I ask the other co-chair, Sanjeev, in case he has some quick comments to make before Ira starts shooting. Sanjeev?
Morning, friends, and my own warm welcome to this Financing 3.0 Summit. And what a way to start this morning with a power-packed panel. Not only do we have the Chief Economic Advisor with us, we have the largest bank with us, we have the largest stock exchange with us. We are going to be moderated by one of the largest and oldest news services, not only of India, of the world. And all this organized by the largest industry association that we have over here. So there's no way this can get better. Now, just a few quick points. We are all aware that the financial sector plays a very important role in any economy, and that's no different from ours. Whether it's banks, insurance companies, asset management companies, over the years has helped our economy grow from about a $350 billion economy in the 90s to the $3.5 trillion that it is today. We are also seeing how technology, led by the digital world, led by the India stack, is transforming our economy and is transforming financial services. So there is a lot that is happening, and yet there is a long way to go, especially in our dream towards Viksit Bharat. So let me touch upon a few things. If you look at our rate of domestic credit to GDP, how much is that credit available to us? We are in our mid-30s. The US, the UK are between 70 and 80%. Clearly, we have a long way to go. Of course, we have to make sure that this credit availability comes with the right quality. Next, our biggest growth engine is the MSME sector. It accounts for 30% of our GDP. And yet, the access of formal financial credit is available to less than 15% of MSMEs. And that means there is a gap of 20-25 lakh crore of credit to MSMEs. And this is not according to me, but the Finance Committee report of 2022. Third, we have a large stock market. And everybody over here thinks overnight we can become millionaires. Of course, some are billionaires who become millionaires. But our larger capital markets are still underdeveloped. For example, our bond markets have a long way to go. If you look at our insurance companies, our pension businesses are still very small and are further restricted by limitations on how they can invest for the long term. And fourth, we will need greater harmony between our various regulators to ensure that our policies, while robust, allow for innovation and are aligned. And let me share with you 6 quick thoughts on how I think we should move forward. We are all seeing in the last decade or two that a number of Indian corporates have not only built scale, but have also gone global. We have to ensure that we have many more financial services institutions that can match them in scale, in capability, and in ambition. Next, we need much greater spread of financial services, whether it's banking products, insurance products, mutual funds, others, pension products. We need to make sure that these permeate all across the country, whether for the individual Indian, for the MSMEs. And in these times where the transformation to a greener earth is very important, we need to channelize green financing to them as well. Third, I talked about the fact that we need a larger corporate bond market. And we need to do this by facilitating new products, by bringing in additional industry participants into it. There is no reason why banks should be lending for long-term projects. They are actually ill-suited because there's a mismatch between the assets and liabilities. This has to come from the debt markets. It has to come from insurance and pension money, and it's our responsibility to facilitate that. Fourth, we've seen the massive technological and digital change driven all around the world and in India. And this is where both the government and the regulators have a very fine balance in promoting innovation, but at the same time controlling risk. The digital age has also exposed all of us, whether as corporates or as individuals, to cybersecurity and data security risks. And this is where the government has released their DPDP Act, and I hope to see rules around it coming sooner than later so that it helps us create a more robust system. New and emerging technologies also mean greater transformation, but this also requires continuous upskilling in jobs. It requires significant increase in financial literacy and awareness. And this is not the responsibility of only the government. It's the responsibility of each one of us as businesses. If we want to do more business, we want to do well, it's also our responsibility to take others, whether our own employees, whether every citizen, or small businesses that work with us together. So let me conclude by saying that for banks and other financial institutions to play this critical role in taking India forward, it is going to be preeminent that we continue to streamline, harmonize, and align regulations with best practices so that we can reduce the cost of compliance. We should not forget that for our ambitious dream for a Viksit Bharat, this will hinge significantly on the robustness, the scale, and the ambition of the financial services system. Thank you.
Thanks so much, Sanjeev. And now I really give it to Ira Dugal, as you described, as the largest and the strongest person on the dais to really question this eminent panel.
That's excessively kind. Some of the excesses on the financial sector reflecting in that phrase. But thank you so much. So I think we've been set up in a lovely fashion with Dr. Nageshwaran talking about what the financial sector may need to avoid or the follies they may need to avoid, and then by Mr. Bajaj on what direction they need to go in. And I think we'll try and keep this conversation a mix of that. But Dr. Nageshwaran, my first question is to you. Your comments as always have layers and layers, and I'm going to try and pin you down on one of those layers. Your comments were made in a wider context, but I'm going to try and pin you down into India. You talked about the fact that financial booms are not always growth enhancers. Let's talk about the nature of the financial boom that we are seeing in India right now. Whether it is on the equity market side, you described it, I won't take up too much time. We all know what's happening there. Whether it's on the banking side, again, very retail driven, very driven by credit for consumption from everything that data tells us. At this stage, as you look at the various aspects of the financial boom in India, do you think they are not adding to growth? Are they subtracting from growth, given that these can lead to follies in the future?
Thank you, Ira. So I think the key word in anything is, of course, the balance.
In balance, yes. So
right now, I think since we are starting from a low base compared to other countries, we have to say that the financial boom or the financial inclusion that it has led to has been growth enhancing. The point is at what point it turns out to be growth subtracting, not growth additive, but more of a growth drag. I think we should be mindful of not crossing that path. But right now, I don't think there is a situation that we should worry about that it not being growth enhancing. And even the paper I referred to by Professors Shetty and Korubi said that there is an inverted U-shaped relationship. There is, up to some point, it does contribute. And beyond a certain level of financialization of the economy, it tends to become a growth drag. But we have not gotten there. But the reason why I therefore made those remarks is that as the market capitalization and as the emphasis on very short-term oriented financial products come into the market, etc., there is a risk that we end up repeating those mistakes, but we are not there yet. And not in a systemic level. And that is the reason why I said, therefore, we should be mindful. But right now, I wouldn't think that the financial sector's great performance and the inclusion it has spawned has so far been growth enhancing.
But you would like to see it broaden out, and we'll get to that through the panel. You would like to see that boom broaden out beyond the sectors we are seeing it in.
Absolutely. Not only broaden out, but also in terms of the kind of horizons that we get people to participate in the markets, longer horizons, not day of the week or the last hour kind of products. And more importantly, we need to ask ourselves the question, what is the leitmotif of the financial sector? It has to be about channeling savings into its most efficient applications. Is that happening? So that is the yardstick by which we need to ask ourselves. And in the US, for example, until 2008, between 2000 and 2008, the share of profits of the S&P Financial Index was rising much faster than the share of profits of the rest of the S&P index. And sure enough, it was a case of an excess, financial excess. And we need to always have internally people asking these questions within the financial sector so that we are able to keep this concurrent growth of both the economy and the financial sector going for a very long time, rather than seeing one outrun the other and therefore topple the real economy.
I think that's a cue to bring Mr. Chauhan in, since that seems to be sort of the most headline-grabbing part of this financialization that we are seeing right now. Mr. Chauhan, as you apply the lens that Dr. Nageshwaran is speaking about to the equity markets, what do you come away with? Do you come away thinking that this sort of endeavor of channelizing financial savings into the right parts of the economy, the productive parts of the economy, is being met partially, or not being met at all, given what you're seeing on the equity side?
Broadly, of course, the economic theories say that the good markets are good for the economy. And in some ways, it's also said today also that Indian markets to GDP ratio is 1.4. Which is actually comparable to rest of the world. But if you look back at the traditional, what I call long-term numbers, it's actually amongst the highest in the world today. It's also reason because the world has, in a way, moved to faster moving technologies. So that's where basically, and very little capital is required to create more capital. The entire concept of capitalism was basically about putting a lot of money to create some profit. That is the sort of framework, the capitalism which Karl Marx saw and all of us adopted over the last 120 years. And it required a lot of capital. Countries like India were traditionally capital starved, post-independence and pre-independence. And that's why we had very few capital intensive industries. And slowly the technology changed. And today, the new framework has come up, which is basically what I call capitalism with very little capital, or capitalism without capital, where you need to put in little bit and you get to create great wealth. And that has happened to many companies. Some of them, of course, go down. We have seen over the last 2, 3, 5 years, even 10 years, that many of those companies have gone down, and we tend to focus on those bad examples, but then there are many good examples which have set up with very little capital, have become very large, and of course, good market capitalization. And that's why I'm trying to differentiate between the traditional wisdom vis-a-vis the current wisdom. Why? The second part is also interesting, that from 1991 to 2014, we were, at least I would have participated in few thousand seminars about financial inclusion, which is also a similar word for financialization. When you do too much financial inclusion, it becomes financialization. That is how now I have come to know. But we were just making noises and nothing was happening. And we were actually ruining the opportunity which India had of financial inclusion. Once 2014 came, all the Jan Dhan Aadhaar mobile came. And now we have a lot of people participating. And we are now saying, now too much of good thing is bad, which is actually true. But we also need to figure out that has world changed? Can it be reversed? Or can it be used for actually productive purposes? The third portion which came about, saying that some of the people have postulated, and some important professors have postulated, that because you have too much of financialization, the country's debt increase and the corporate's debt increase. In India, both have not been true. Country's debt to GDP has not increased as much, nor the corporate debt. In fact, India's banking system, total size, vis-a-vis GDP, is now less than half. While as China has probably 3 or 4 times, America has 3 or 4 times. And that's where, for me, if you control those parameters, that the corporates don't become indebted compared to what they need to, and if you continue to take advantage of the newer technologies, which allow you to create huge wealth with very little capital and allow many more experiments, I'm sure our capital markets can play a greater role. And that's what they have done with Zomato, with Swiggy, whatever. I mean, you can say many such examples where they have been able to create great wealth, great new models, and we need to be aware and also try to channelize rather than trying to think, how do we stop this? That's how I would like to put it in a nutshell.
Okay, so you're saying, sorry, go ahead.
Go to the next question. I just wanted to bring up one last, this is the slide that actually vindicates the point that Ashish was making. What you see here is the overall credit given by the entire financial sector, not just the banks, to the economy, excluding the government. So the source of funding is banks, non-banks, foreign sources, etc., which is the line. So in the case of China, what you see is bulk of it is actually coming from domestic banks, which is the blue bars. In the case of the US, the bulk of it is coming from non-banking sources, which is why the gap between the blue and the brown is very large. In the case of India, it seems to be at the moment a good balance. So I think we need to make sure that both the capital markets and the banking sources of financing both grow in tandem, rather than the top two being excessively unbalanced towards one or the other. So India needs to watch these two as extremes that we need to avoid. Thank you.
No, okay, so that we have to maintain that very fine balance, which brings me to the bankers on the panel, Mr. C.S. Shetty and Mr. Bajaj. Mr. Shetty, to you first. On the banking side, if that graph was subdivided over the last 5 years on where that banking capital is going, we know there has been a skew, and the skew that not everybody is comfortable with. It's been very heavily driven towards retail, maybe not by your bank, because, nature of your bank is that you have to lend to everybody, but has banking grown in tandem with the economy and contributing to the economy's needs in the right way, particularly in the last 5 years as we've sort of come out of a bad loan cycle and started to sort of ramp back up?
Yeah, I think a couple of points what Dr. Nageshwaran, Mr. Chauhan and Mr. Bajaj have mentioned. If you really see the way the financial services sector, I like one statement Dr. Nageshwaran made. The financial sector displayed greater responsibility. I'm very happy to hear that, sir. I think because there's always a feeling that there have been excesses. The asset quality review of 2015 and subsequent NPA recognition, recapitalization of public sector bank, resolution which is under IBC, I think the shift from the corporate banking to the retail personal has significantly happened. It should have moved to MSME and agriculture, obviously, the small value loans. It did not happen because one is conventionally these sectors were not too formalized, and they had their own issues of credit absorption, which has dramatically changed post digitalization, number one, and post formalization, GST, for example, today. So to come back to your question, that yes, there has been a shift, obviously. If you see the composition of many of the balance sheets on the asset sides of the banks, predominantly retail personnel, home loans and other things. But what we are seeing that the formalization, digitalization has helped us to devise models today to reach out to MSMEs which were not otherwise getting the formal credit. Again, to quote Mr. Bajaj, he was saying, I think a significant part of MSMEs are still not covered. There are three issues other than credit, in my view, what MSMEs require when we want to broad base the credit deployment by everyone. I think the banks and financial institutions seem to be gaining confidence in lending to this sector because of the formalization. But what is more required from the MSME sector, particularly if they're aiming at scaling up, is that credit is important, governance is important, technology and market linkages. I think these are the four items which are the pillars for MSMEs to grow. We all keep talking about MSMEs requiring credit. I'm not undermining that credit requirement. But credit absorption also is dependent on three other pillars which we keep talking about. I think it is important to work on that. And the financialization, what Mr. Chauhan has been talking about, I think is inevitable as the economy develops and progresses. It has been traditionally a banking-led economy as far as the savings is concerned. Now some of the savers are getting converted to investors. The moot point would be that how do we bring this money, which is going to pension funds, insurance, and the equity markets, into the capital formation. And one suggestion, what Mr. Bajaj has mentioned in terms of the deepening of the corporate bonds. There is only so much the commercial banks can do on the corporate bonds, for the simple reason that if we have an exposure to, say, Bajaj Finserv, our exposure, whichever form it is overall large exposure framework. So it is important that non-bank participants have to come into the corporate bond. If the savings are going to insurance and mutual funds and the pension funds, they have to have products to come into the corporate bond market. I think is very important. That is how the capital will come back. Otherwise, we keep talking about how the deposits not growing in the banking system is going to impact the credit growth. So the credit growth probably would be driven by all the financial sector players, not banks alone.
Fair enough. Mr. Bajaj, I'll come to you on this point about SMEs. We've spoken about this for so many years, and we've heard so many banks, non-banks talk about focusing on lending to SMEs. Firstly, there's no data, so we don't know whether the inclusion on SMEs on that segment has improved or the exclusion has come down. And I really wish there could be some way to analyze data, Dr. Nageshwaran. I'm sure you have more access to that. But to the point of what is driving this exclusion, which we all assume is continuing, it's not lack of will to lend. It is obviously still lack of absorption capacity. We're talking about a new credit model. Is that the answer? Is distribution the answer? I just feel that after many years, we have to now sort of narrow down on where the problem is to try and solve it.
So, Ira, as you mentioned, there are a number of issues that drive this lack of penetration. But the simplest is not enough competition. Look at banks, NBFCs, including ours, including SBI, over the last 6 or 7 years. Look at our balance sheets, look at our P&Ls. Let the one COVID year maybe be put on the side. Everybody has done very well. The selfish answer is, why do we need to do more? Only when MSMEs have 3 banks and NBFCs standing outside to lend to them can we say that there is enough credit available to them. I don't mean enough actual capital being available, but nobody needs to work hard because there is enough other easier ways to lend. Now, the digital stack is making a big difference. ONDC as a marketplace is going to make a big difference. The account aggregator framework released by the government is going to democratize. Actually, other than State Bank of India, everybody else will benefit. They are so big that they may only lose some of their customers there. But by doing these and by encouraging the growth of new banks, new NBFCs, this is how you will see greater credit going to the market. And look at what happened in the retail segment in the last 15 years. A Bajaj Finance's success and that of many other NBFCs and the tremendous transformation that an SBI can do on the digital side has only happened because of greater competition and the growth of India's economy, the growth of per capita GDP, so the earning power and the spending power increased, and the digitalization of financial services in India. So what we have seen happening in retail now needs to happen with the SME, MSME sector.
Fair enough. Mr. Chandrajit Banerjee, if I can bring you in as well, would you put that at the top of your list in terms of priorities? I won't call it reform, I'll just call it sort of policy priorities for the government, for the financial sector, this whole SME piece.
Yeah, of course, because, for India's small and mid-sized companies to be a part of the entire success story and to be linked to the supply chain, and with the challenges which are coming forward, I think areas like green financing, the transition to on digital transformation, to say, and when we really talk about areas of ESG, all of that, the play for the SMEs are becoming critical. And of course, the issue of the absorption capability, that's challenging, but the role of financial institutions also become critical into seeing how we are able to really reach not just the small size, mid-sized companies, but even actually we get the micro to be competitive and to be plugged in well into the supply chain. And I think institution like ours, along with the financial institutions, have a huge role to play in making it happen. And I think there is a lot which has happened, as we've seen in the last few years when we have looked at how the financial sector has played a role on through technology and through digitization to reach out. But I think there is a lot more to be done, because that's something which is required. And I'm particularly worried about those two areas which I mentioned in the beginning. That is about the green transition and also technology adoption. I think that these are going to be critical challenges as we go ahead for the SMEs. But I just wanted to, Ira, with your permission,
Yes.
take the advantage of this high-powered panel, and also, one of the things that the Chief Economic Advisor pointed out during the presentation was the capital flows to the emerging markets, which has actually remained pretty healthy, as you have said. And with the US Fed now really looking at, the rate cut over a period of time, how can the emerging markets tackle the challenge of the likelihood of a sharp rise in the capital flows of the economic parameters, including exchange rates and all? Now I'm asking this question to you.
That's yours, Dr. Nageshwaran, to answer. No, that's to you entirely.
No, I think before I answer CB, I have to add one more disclaimer, because in my initial speech I said my remarks were personal in nature. Now he's asking me to go back to wearing the hat that I wore for about 17, 18 years before I stepped out of that role as a capital markets participant. So I think you are right, CB, with the expectation in the market very clearly embedded that the Federal Reserve will be easing, and in fact the market is betting that the easing cycle will be both sharp and aggressive. I don't know about that, but if that is indeed the case, and the good emerging market credits will definitely see capital inflows, which means we have to be very sure about the ability of the economies to absorb that capital productively. Again, I go back to the 2003-8 period. India experienced a massive surge in capital inflows, and some of it couldn't be digested. Of course, now we are a much bigger economy. We can do that better, a lot better than we could do at that point in time. So I don't think the risk of the episode of 2003 to 8 a surge in capital flows leading to unproductive investments, that probability is on the lower side. However, and I mean, as economists are always supposed to speak with two hands, not just one hand. On the other hand, therefore, I have to say, if the Fed rate cuts also end up sort of getting coinciding with the rise in risk, rise in uncertainty because of geopolitical events, then the question is whether the rate cuts in and of themselves will necessarily result in capital flows, because other things are not remaining constant. So the last time when the Federal Reserve had its massive rate cut cycles post 2008 crisis, or in 2001 and 3, etc., the global political environment was nowhere near as fraught as it is today. So therefore, it is going to be a big question mark whether this time around the rate cut cycle will lead to a big jump in capital flows as it has happened in the first decade and the second decade. Therefore, I think emerging markets should not be betting on it. And if it does happen, then the question is, we have to make sure, not just India. India has done a much better job than other countries. We have to make sure that it doesn't lead to one more cycle of accumulation of hard currency debt, resulting in debt distress down the road.
Okay, I'm sorry. I'm going to go back to my sort of banking question. Dr. Nageshwaran, what is the role of government in this, in ensuring sort of, credit flow to productive sectors? We are talking about SMEs. So there, I think some announcements were made in the budget to try and speed that along. Is it the government's role, or should it be an entirely free market mechanism to see whether credit flows to these segments? Also regulation, right? I mean, for years, for decades, we've had priority sector. We've tried differentiated banking models, not sure they've entirely worked. Do you see a substantial role for the government at this juncture, or government and regulation? Dr. Nageshwaran, that's to you. Yes.
No, I think the role of the government should probably be more limited than what it was earlier, to make sure that the regulatory aspects are well taken care of. Having a well-regulated market is not the same as an over-regulated market. I concede that. I think Mr. Shetty made very interesting points for MSMEs that they need credit, governance, technology, and market linkages. And but Sanjeev also pointed to the fact that what has been happening, the digital stack helping financial inclusion of individuals can actually now diffuse down to the SMEs as well. I think, but the regulatory framework where we apply some of the Basel norms, etc., for SMEs as we do to other normal credits, I think that we can become a little bit more tailored to Indian context. That is not yet happened. And then the other thing that can happen, and this is not necessarily the government's area. The second area, which is also unrelated to government, is the corporate sector, the corporate customers, whether it is public sector or private sector, they must take to the discounting of invoices in a much more massive scale than they have done so far. So if that happens, and if MSMEs working capital cycles improve, actually the access to banking finance also will improve. So there is a sort of a chicken and egg situation here. And in both these matters, I think the role of the government per se is relatively small.
Relatively small. Mr. Chauhan, actually on the equity capital side too, we've seen some positive development with smaller companies get access via the SME platforms, although there's nervousness there because, some of the numbers and examples that you see around could point to risks building up. What's the balance there as you watch that segment? There is genuine activity which is encouraging, but there is some need for sort of either exchange or regulatory intervention to ensure that, boom and bust cycles don't happen, because those bust cycles can do a lot of damage then.
No, I think, it seems to be emerging that too much of good thing is bad. And so too much of SME sort of framework also, SMEs getting too much funding or their prices going up is also bad. And that's what creates apprehensions across, saying there is a runway growth there, and we need to be very aware and take actions against. So somewhere the balance, as Dr. Ananth Nageshwaran said, that we need to be somewhere in the middle path. And that's what both exchanges have tried to do. In fact, if you recall, around 94, 95, that is 1994, 95, there several companies came to markets, they took the money, ran away, they were not to be seen, they were known as vanishing companies. So both exchanges stopped taking the prospectus for small companies together. And then in 2007, the industry bodies like CII and others took up with government, saying there is a legitimate need for small companies also to raise funds, because when they go to take funds from the banks also ask for debt equity ratio, and if there is no equity, how do they give debt? And that's where in 2010 government came out with the regulations that you need to have small companies also allowed on stock exchange to raise equity funds. And so in 2012 finally the first company started getting listed. Now almost 1,000 companies have got listed in small markets. Many of them, as expected, have not done so well. Some of them have done very well. But overall, there is a perception that currently in a situation where markets are doing very well, many of the fly-by-night or not so good businesses are also coming. And some examples are also being given in newspapers, which are correct. And that's where the exchanges are taking cognizance. SEBI has also over the weekend made a statement that they are going to come out with new regulations on SME, which will be much tougher. But exchanges, at least NSE, has brought the bar up several notches, and will continue to do that going forward as we see that euphoria building up. So for me, we will have to continue to maintain that balance, and it's not easy to maintain, because one side you go, people criticize you, the other side you go, people criticize you. So in some ways we are there to be criticized, and we would of course seek the suggestions and continue to work despite whatever criticism even coming from IRA. So that's how our job is, and we need to continue to do our job.
balance. It's tougher to get than to speak about. I'm moving to one other issue, and this is to Mr. Bajaj and Mr. Shetty. And this is not specific to MSMEs. This is the question of whether one model will answer all the financing needs of the economy. It could be an SME, it could be green financing, it could be other, infrastructure financing. Mr. Shetty, we have experimented with differentiated banking models, some under banks, some under non-banks. Somehow, we come right back and say that all that's going to work is a universal bank. So what is the answer? That banks have to build this capacity in-house, but you need different talent pools, you need different credit appraisal skills. Is that the only answer? Because if we go right back to talking about differentiated banking so soon after the last sort of round has, not been wildly successful, I'm not sure we'll get any answers.
I think while we continue to work towards differentiated banking, what is important is how do we develop the skill set within the universal banks to handle. When we talk about the skill set, every activity of financing requires a different set.
Absolutely.
I consider even giving a home loan is not an easy task now with a highly competitive world what they are. We need to continuously innovate in terms of delivering the products. That is one. But when we come to the complex models of corporate financing, especially in the new emerging areas, battery storage or hydrogen, I think they also require capital going forward. While we expect that much of the capital probably would come from overseas and support the domestic capital formation, the universal banks are also expected, particularly large banks like SBI would have to play an important role in the infrastructure financing. We run the largest project financing department in the country today. And we find that despite our years of expertise in project financing, the skill set required to assess the emerging areas is still lacking.
Absolutely.
So a couple of ideas what we have is that whether we can set up a center of excellence on emerging areas and collaborate with both MDBs. MDBs also do a lot of work on these areas and also some of the large MNC banks. We are working on that. Hopefully, I think that creation of specialization within the universal bank is need of the hour. And not necessarily in the large corporate lending, even MSMEs.
Yes.
MSMEs also, their requirements are going up. As I said, I still believe that a large bank like SBI should not only be looking at financing the MSMEs, whether we can handhold them in the three important other areas which I mentioned, in terms of governance, in terms of technology, what is that we can do? And one more important thing, what we must realize that I think financial sector is the most integrated sector technologically today. Mr. Bajaj mentioned in his opening remarks about cyber security. See, the integrated system which is developing among the large financial players, fintechs, corporates, MSMEs, is creating the interconnectedness which is extremely becoming vulnerable. I think it is important that we also have to develop the skills internally across the industry, both in the financial and non-financial, that how do we handle this risk which is emerging on the cyber security. One example I can give, while the government probably may have to play a limited role in financing MSMEs, but there's a great amount of activities which they can take up. I happened to visit Canada recently. In the government of Ontario has floated a special fund to support the cyber security measures among the MSMEs. They first help them to understand what are the gaps, and if need be, they give some grant or something to encourage them to adopt the best cyber security practices. I think all the players, including CII, should focus on this critical feature, which is going to create, as we go for more and more digitalization, I think this is one important imminent risk which we need to handle.
Absolutely, and since both of you have brought this up, I'll definitely come to that. But Mr. Bajaj, NBFCs were supposed to do this job of differentiated sort of, models in some ways. Pick one area, focus on it, specialize in it. We've seen that just dissipate. Is it regulations that, NBFC is also being regulated more and more like banks and hence don't have that ability to differentiate? Or is it something else? Is it just, bad experiences that have gotten banks and NBFCs to all look the same in some ways?
So, the past always gives us clues for the future, but the past does not have to be the future. And to your earlier question to Mr. Shetty as well, there are already a variety of bank licenses.
Yeah.
You can be a universal bank, you can be a small finance bank, you can be a regional rural bank, you can be a cooperative bank, you can be an NBFC, a non-bank bank. So you have a variety of models already in place. What we have to ask ourselves is the model wrong or is the construct wrong? We know, unfortunately, most cooperative banks, regional, rural banks have stayed small. None of them have built top world-class success stories. Even a number of the SFBs have not done that well. I don't think the model is wrong. We have to question the construct. Do they have good quality management? Have they implemented good risk processes? Do they have a clear path to how they will raise liabilities? How do they manage asset liability mismatch? Is the senior management's incentives aligned to build a good long-term institution? Do they have the power to do that? We know if you're a cooperative bank, what kind of local influences come in. How do you expect these institutions to build good quality businesses? And we have a few great examples of, again, successful public sector banks. But there are many others that are not. And the same is true in the private sector.
Yeah.
So it's not that the private sector is doing everything well. So to me, it's a question of governance. It's a question of alignment of incentives with outcomes. And like they say, the old adage, Rome was not built in a day. It has taken us 17, 18 years as Bajaj Finance to build a reasonably good size, capable NBFC, and we still go to work every day as if it was day one, what Bezos says. Because the opportunity is so large that you know that you are going to get there, but you have to make sure you get there with quality, you get there with low cost, and as we are building good businesses, you also have to make sure you're not just creaming the top, but you're trying to do good social or do social good as well. And we have always believed that if we have to take financial services to the masses, this is not social service that we are doing. We're going to make money at the end of the day. We're not doing it as charity. Our CSR work is separate. But we have to find the right ways of doing it. We could very well have concentrated as Bajaj Finance in the top 200 cities and had enough business for the next 10 years. Because we are so small. Even today, we are 2% of India's banking credit. We are today in over 4,000 cities and towns because we believe that as we get, we must give. And I think it's a set of these capabilities that need to be built. Your type of license doesn't matter.
Exactly.
2007 is when I moved to overseeing financial services. By 2009 or 10, we had analysts, investors telling us, you guys are getting into multiple business lines. NBFCs are just supposed to be in one. They're supposed to be monoline. And my question to them was, but why do banks do so many things? No, but that is a bank. So I said, but what is an NBFC? It is just another license. What we have shown is that you can build a robust, diversified lending institution with good quality. And we are nowhere near perfect. We have enough mistakes that we make every day. But we learn from them, we keep improving, because the opportunity has come in tremendous. And without complimenting the government unnecessarily, I must say that the government has been an unintentional to us, to the system they're intentional, positive ally with all the digital infrastructure that got created, the economic growth. See, today we are feeling bad, first quarter 6.7% growth. Yes, we want growth to be 8, 9, 10% so that 50 million new jobs get created for youth so that they become consumers as well. But in this world, 6.7% is a very good growth rate. Not for us to go back to sleep. But let us also recognize the overall environment and where we are. So I believe there is a lot to be done, but it has to be done in a capable manner.
Dr. Nageshwaran, just coming to you on two thoughts, actually, both what Mr. Shetty spoke about, trying to build capabilities in these individual industries. Maybe that's where the government can help, not in the financing, but in trying to build these capabilities. We talked about cooperative banks. Nobody even talks about the fact that we actually have a ready-made network out there if we actually want to go out there and lend to SMEs. We've never managed to do anything about that. Are there some of these sort of, blue sky ideas that we can work on?
I think in terms of the blue sky ideas, CB was telling me some of the initiatives that the Confederation has been undertaking, perhaps that really falls into the definition of what you would call blue sky thinking. Maybe we should hear him out on that.
Mr. Banerjee?
No, thanks. A couple of things where I think we look at beyond banks and NBFCs is where private sector also participates in it. So one of the things that we've started an institution, which is again a pan-India institution where we look at geographical as well as sectoral clusters, around 200 clusters now working, where private sector, large corporates comes into funding, into seeing how you can create efficiency and in many areas, including say exports and all for our small and mid-sized companies. But another initiative that we've just taken, and I was talking about the visit of the global chairman, managing director of Rockwell Automation, to say that companies like them and Indian companies to create clusters and of MSMEs in India, micro enterprises, mind you. We've adopted 5,000 in Tamil Nadu very recently, just about a couple of weeks back, to see how we can help them transform through private sector, sort of providing the full finance of their transformation, both in terms of their appetite and understanding towards not just technology adoption, but also to really be more efficient, because we also see employment generation coming from that sector. So private sector giving. In fact, it's great that Mr. Shetty is sitting here, because one of the models that we were looking at is a big company sort of instead of giving sponsorship to CII to do those 5,000 companies, and in each part of the country we are going to move around, we'll say we'll guarantee to the bank, and we want the MSME to actually borrow, so that they feel that they have borrowed and they have actually their. So if anything is free, sometimes it's not very good. So when the private sector gives it, it'll give it to us as a complete grant. So we want to be a guarantor, the large company, and the bank then gives it. So that's a model that we have just started working on.
Sounds interesting, Mr. Shetty.
In fact, again, when we come back to the credit absorption capacity, I remember one incident I would like to quote here. When PM Swanidhi was launched, everybody was very skeptical. 10,000 rupees, what is that? It is going to move the needle. And I was part of the scheme, devising the scheme. One problem what we faced is that how do we deliver 10,000 rupees, whether we should make him to sign a document or we just credit to his account, and anyway he's identified by the local municipality or somebody and he's given an identification number. But we heard that the Honorable Prime Minister said that it should not be simply given to the credit, it will be seen as a grant. The person who is taking should know that he is being given financing and he has to utilize the financing, and if he utilizes it and repays, and he should be given additional financing. And how do you bring, and in fact today, while the small value loan of PM Swanidhi, today the third tranche, fourth tranche, people are coming back and taking it. I fully agree with what Mr. Banerjee mentioned in terms of anybody should have a little bit of friction to get a money. I think that friction today is too high. That is the reason they're not able to get we have to reduce the friction, but completely eliminating the friction by getting grants and all is not good for us. But I still would like to say that while we are reaching the bottom of the pyramid and the scalability is not coming because much of the time the credit also is required to be backed by collateral. This is the usual mindset. If you have to transition from a collateral-based lending to a cash flow-based lending, which is possible now with the data coming in, this transition also, I think the title what Dr. Nageshwaran mentioned, policy and mindset changes in financing, requires a mindset among the lenders.
Yes.
And before that mindset changes happen, a little bit of support from the guarantee agencies is required. And that's the reason I think there's a budget announcement on the guarantee program. This guarantee, I say, will help the people to scale up. And CGT MSC kind of guarantee play a very significant role in this. We internally in SBI believe that up to 5 crores, we completely want to move from a collateralized based lending to cash flow based lending backed by the guarantee, which will give enough traction to the growth of the micro enterprises to become small, small to become medium.
These guarantee agencies, I mean, there's been many views on it over the years, right? You have to make sure they're adequately funded. They can become sources of risk in themselves. Do you want to comment, Dr. Nageshwaran, on whether that's one route to take? And also credit enhancement agencies, if you look at infrastructure, we've struggled in setting that up as well.
I agree that there are, at the initial stages, you need to have some backstop mechanisms to catalyze the sector, and afterwards it can take care of itself. So, I mean, whether it is in ensuring that the guarantee schemes function, both in terms of capital infusion and also the mechanisms when you can invoke the guarantee, and therefore what it does to the RBI's treatment of those assets as non-performing or performing. It's all these things have to be consistent and aligned to each other. I mean, so just to quickly respond to your earlier question about I don't think we need more blue sky thinking as much as just making sure that what all we have put in place in the last several years function properly. So whether it is the insolvency and bankruptcy code, having enough insolvency professionals and making sure that we come down to 270 days as we promised earlier at the time of inception. So most of these things is about executing now rather than talking about blue sky thinking.
No, that's fair enough. Let's get what we have in place working. Last question before we sort of wrap up, because no financial sector panel is complete without talking about the lack of a corporate bond market. Mr. Ashish Kumar Chauhan, do you want to come in on that? We've seen good traction on the equity side, pretty much none on the corporate bond side. What's going on there?
In a way, corporate bonds are not easy to solve despite our, and it's also including the bank loans. The bank loans today, as a total banking system size as a percentage of the GDP is pretty much half or in that range, and much lower in terms of the percent of market cap, right? So why this happens is because if we cannot create a framework for banks or for the lenders via bonds, ability to take over the assets fast and kind of liquidate them in case of defaults. We will have, we'll continue to have many such conferences. We'll have many more interesting news articles and papers published by all sorts of professors from across the world. If you cannot solve that, basically the issue of if Abhimanyu goes into Chakravyuh by lending, how does he come out with whatever limbs left, you know? So if we don't, for me, the bankruptcy code was a great beginning, but now we have made it reasonably ineffective because we are not able to do it very fast, although there has been good success vis-a-vis the earlier act called the CII Act, that is Sikh Industrial Companies Act 1985. I used to be one of the users of that as a banker in my early part of my career. And so I know we couldn't collect anything, at least in last 10 years we have collected a lot. But if we can do a personal bankruptcy framework, if we can do a very fast moving corporate bankruptcy framework, and if we can do also a bankruptcy resolution framework for financial institutions. Somehow the financial institutions bankruptcy framework has been put aside because of whatever opposition that came about. But effectively, if we cannot have a good bankruptcy resolution framework, which is extremely fast, quick, and you can say that because only some of the institutions can do it or under certain guidelines. But if we don't resolve, my understanding is, why would person give money when they are not sure that if it doesn't come back, what is their recourse, right? And so we can continue to debate, discuss, and look very sort of intelligent. But if we don't solve basic questions, I have my doubts on this kind of markets coming up further.
That's for a different panel. I'll close off here, but perhaps I can request Mr. Shetty to help us summarize where we are at right now and where we're going. The reason I ask you is that you're taking over the largest bank. So in some ways, your priorities will tell us where the financial sector's priorities lie. So very short sort of summary, and then we can close off. He has taken over, yes.
Yeah, thank you, Ira. There are a lot of things that are happening in the financial services sector. I think there's never been a dull moment in the financial services sector, for good or for bad. I think I'm entering, took the charge of SBI with a twin balance sheet advantage. I think while we keep talking about it, it's really is evident when we look from the top that today the corporates are stronger. In fact, a lot of corporates, when we talk about why the private capex is not picking up, I said that corporates have so much cash. They are actually first spending their cash. And then only if you are measuring your capex by way of corporate credit, it is not evident because they're borrowing. So I think the twin balance sheet advantage of banks being stronger now, financial service sector stronger, corporates are stronger, and the whole ecosystem in terms of financialization, digitalization, provides an ample opportunity for all of us. And the new age players can collaborate with the conventional, I don't call them old age players, conventional players, universal banks. I think this collaboration is going to be transformative. And the ecosystem like account aggregators, and many of them, how do we combine all of them in a very holistic manner, in a kind of self-regulated manner wherever regulations are not there? This will sum up the future of the financial services sector. In my view, it's a good time to be in the financial service sector. And how do we align the financial sector objectives to the larger objective of Viksit Bharat is something what we have to work quickly and with clarity. I think that would help the country as well as the financial service sector.
And how to avoid the mistakes of our past and others' past, as Dr. Nageshwaran themed his discussion. Thank you all so much for sitting through this. I hope it was useful. I'll hand back to Mr. Banerjee.
Thank you all for the engaging deliberation and enlightening insights. I request all of you to please come together for a group picture. Ma'am, please. Thank you all. With that, ladies and gentlemen, we conclude this session. Kindly allow us some time for a quick changeover. Check. Yes, thank you. So, ladies and gentlemen, we are not breaking. All those who have moved outside the ballroom requested to please come back and settle in your places. We will be beginning the special plenary session with SEBI, that is the Securities and Exchange Board of India, on regulatory landscape, what is needed for Viksit Bharat immediately. So all those who have moved out requested to please come back and settle in your seats. So ladies and gentlemen, we will have Madam Madhavi Puri Buch, Chairperson of the Securities and Exchange Board of India, as also Mr. Sanjeev Bajaj, past President CII and Chairman and Managing Director Bajaj Finserv Limited, and Mr. Chandrajit Banerjee, Director General CII, joining us in this special plenary session, which will begin almost in the next couple of moments. So all those who have moved out of the ballroom, I once again request you to please return to your seats. Thank you. Ladies and gentlemen, I announce the arrival of Srimati Madhavi Puri Buch, Chairperson SEBI, the Securities and Exchange Board of India. I welcome you, Madam, onto the stage, along with Mr. Sanjeev Bajaj, past President, CII, and Chairman and Managing Director, Bajaj Finserv Limited, along with Mr. Chandrajit Banerjee, Director General, CII. Welcome, everybody. Ladies and gentlemen, I urge you in earnest to please return to your seats. We are beginning the special plenary session with Securities and Exchange Board of India, SEBI, on regulatory landscape, what is needed for Vikasit Bharat. Ladies and gentlemen, as India strides towards becoming a developed nation by 2047, a fortified and robust regulatory landscape will play a pivotal role in fructifying this goal. This session will take stock of the current regulatory architecture along with deliberating on the supportive regulatory frameworks further required towards bolstering the financial sector. With those words, I request Mr. Chandrajit Banerjee, Director General, CII, for the welcome address of the session and also to moderate the session thereafter. Mr. Chandrajit Banerjee.
Welcome back, ladies and gentlemen, and a great privilege and honor to welcome is very specially and warmly the chairperson of SEBI, Mrs. Madhavi Puri Buch. Chairpersons, welcome back to a forum with the industry once again, and we really value your time, leadership to spend time with this very, very strong and a very high quality audience where we are talking about the role of the financial sector and Viksit Bharat as we look at it. We have the chairs of the summit, so to say, the financial summit chair, the chief economic advisor, Dr. V Ananth Nageshwaran sitting here, and of course Sanjeev Bajaj, who have been chairing this summit for and preparing for it for the last many years. And Madam Chairperson, the subject that we have kept for your session is the regulatory landscape and what is needed for Viksit Bharat. Chairperson, I just wanted to mention that so a few things that we have been able to do since we have met in another public gathering with our institution and yourself, both in Delhi as well as here, has been some of the things that we have seen which has moved so very effectively. Just wanted to recap them, and it's been you who have actually made things to work in a very different manner. I think one of the highlights was, of course, the Industry Standards Forum, which you constituted, and that's worked so very well, and that collaboration has been of great value. The second, I just wanted to also talk amongst ourselves and really laud in terms of the landmark achievement of SEBI in the recent past. It has to catalyze the transition from T+2 to T+1 settlement cycle and making the stock market the fastest growing in the world, as we have seen. And further, the T+0 settlement cycle has also been rolled out. I mean, briefly capturing this just for a recall. The third, of course, which has been again where we have seen the expert committee for facilitating ease of doing business. And that's been, again, something which we strongly appreciate from our institution, the determination to streamline the corporate regulatory framework. And that's been of great value. And the expert committee, which came out with those recommendations for facilitating ease of doing business and also harmonization of the provisions of the ICDR and LODR regulations. So that's again, Madam, was of very, very important and great value. The next, of course, was the formation of 16 working groups to simplify the SEBI regulations. And again, saw a phenomenal collaborative work. It's been seen and very encouraging to learn that SEBI has accepted. We have seen 70% odd of the proposals of these working groups being accepted by SEBI. Another one, again, which we have been really talking about within the industry has been about BRSR, and wanted to really congratulate and thank the SEBI for developing the BRSR and the BRSR core initiatives. And they really go a long way in ensuring that we are in line with the global standards. And we look forward, this is something which is going to really help our companies, our members. So great to have some of these achievements in a very short period of time, if I may. And today we really look once again turn to the SEBI chairperson for her thoughts on how the regulatory environment can foster market growth and stability, and to prepare for the financing of this growth in a rapid way towards the Viksit Bharat. I just wanted to recap just to say that we have done a lot and we still wish to do a lot in this partnership approach, Madam Chairperson, and welcome you once again, and thank you very much for being here with us for this summit. Thank you. Sanjeev, before we request the Chairperson, a few remarks from the summit chair.
Good afternoon, friends, and it's a pleasure to have with us Chairperson SEBI to deliberate upon what should be the evolving regulatory framework as we lay the foundations for a Viksit Bharat by 2047. Now, we know that a robust regulatory environment of our capital markets is required not only for investor protection, but it is also required to pursue innovation, to ensure greater market efficiency, and to ensure greater inclusion. As India moves forward and is poised to become the third largest economy globally, we know that the scale of financing in the country has to improve dramatically. And to do this, we have to first ensure that we are building greater resilience, because scale without resilience can lead to disaster. One of the ways to do this is to encourage the shift of our savings from traditional assets, whether it's cash, whether it's gold, whether it's real estate, towards financial assets, which are more productive. And money, as they say, has value only when it changes hands. If it's sitting at one place, it has very little value. Further, whether it is simplifying the investment process, saturation of products and services, reducing transaction costs, each of this will further enable a larger set of people to invest in financial products. We also know, and for those of you who were here in the first section, we discussed the fact that while we have a very large and strong equity market, we need to build the bond market, and perhaps we will hear a little bit about that. Currently, whether it's REITs or InvITs, these are classified as hybrid securities, and we believe that there is some ambiguity amongst investors about their asset class. We believe that these should be allowed as asset classes, whether for ETFs or index funds, of creating a framework for mutual funds to also launch REIT or InvIT specific schemes would further bring in liquidity into these asset classes. CB just talked about the BRSR report. We know that the world is increasingly moving towards adapting ESG principles. I was recently, a few weeks ago, at a meeting of the World Economic Forum in Switzerland, and the top financial companies were together discussing how the roadmap is evolving towards the transition towards a greener planet and the obligations on green financing. And this is where India both can play a very significant role, because we are part of that transformation journey, and unlike many other countries, we have proactively said that we will move towards a developed nation, but we will also do it with our responsibility towards the climate. But here, one of the things that is required is a harmonization of regulations, not only between international, which is mostly European regulations and Indian regulations, but also that harmonization doesn't mean that we have to just follow their regulations. The regulations have to be suitable even for countries like ourselves. And I hope that we will see some of that happening. Another requirement to ease compliance for listed equities that are there across multiple exchanges is if we can create a common disclosure platform that could be established where a single submission meets the reporting requirements of all exchanges. An important area as we move over the next 2 decades is retirement planning. Now, if you look at our current pension fund of India, it's only 2% of GDP, far lower than what we have seen in the West and what we've seen as required as our elderly population grows in size. In addition, when you look at the penetration of pension products in India, amongst the elderly, it is less than 25% versus 70 to 80% in, again, the developed markets of the world. And this is where driving awareness, fostering innovation, reducing transaction costs, improving distribution will go a long way to ensure that in our sunset years, we have adequate protection. As India navigates the path towards becoming a developed nation, hopefully even before 2047, a forward-looking and resilient regulatory landscape will be instrumental in ensuring that our financial services sector establishes 3.0, 4.0 and thereon. As CII, we are very much committed, as we've always been, to work with SEBI in helping simplify regulations and thereby unlocking the true potential of India and Indian industry towards a Viksit Bharat. Thank you.
Thank you. Thank you very much, Sanjeev. And ladies and gentlemen, it's now my pleasure and honor to request and invite the Chairperson SEBI, Mrs. Madhavi Puri Buch, to give her keynote address.
A very good afternoon. It's a pleasure to be here. I must say that as we think about Viksit Bharat, there has been one photograph that I've been using as my understanding, not my understanding, but my hope and my aspiration of what Viksit Bharat will actually look like. So I'm going to use that again. This is my hope and aspiration for a Viksit Bharat, where in every part of our country, including in rural India, the girl child is educated, she is healthy, she is tech-enabled, and she is smiling. That would be the Viksit Bharat that I would hope for. How will this Viksit Bharat come about? To me, there are some building blocks towards this aspiration. So, the first thing is that for Viksit Bharat, there has to be economic prosperity. That's a no-brainer. In order to facilitate that economic prosperity, there has to be growth. And for that growth, national resources have to be there. When I say national resources, I mean not just the capital that is there in the country and which comes from outside the country, but also to facilitate the generation of profits, reserves, taxes, and all of the resources that India has, both monetarily and in terms of the huge capability that we have as a nation, in terms of people, our capability, our technology. So all of that national resource will really drive the growth and the economic prosperity. At the same time, national resources also need to be utilized for building social infrastructure and sustainability, because that is what will also drive inclusion and participation. Because just economic prosperity without inclusion and participation, active participation of every citizen of the country, without that side of it, we cannot expect that we will achieve a Viksit Bharat. Now, on this path and on this wonderful virtuous circle that we can see before us, The good news is that we are no longer just talking about we can get there or that we have the potential to get there. I think the beauty is we are already on this path. For the last many years now, this bringing together of national resources, both monetary and capability and technology, has already started driving the growth and economic prosperity. It has already started driving social infrastructure and inclusion. So even today, when you open the newspaper and you see GST collections are 10% up. You know, when a lot of foreign investors come to see me and they ask me my views on the economy, and I say to them, look, I'm not an economist, so please take what I say with a pinch of salt, but I'm a markets person. I find it hard to think in terms of models. I like to look at simple data. And to me, there are two important sets of data that I look at when I need to figure out on what kind of trajectory India is from an economic perspective. The first set of metrics I like to look at is taxes. Because taxes are a reality. There is no assumption, there is no model, and nobody pays taxes unless they have to. So, with the growth in taxes, whether it is the GST collections, month on month on month, the way the chart looks, quarter on quarter, if you look at the advanced tax, and many of our investors from overseas are not very familiar with the fact that we have a concept of advanced tax. So when I share with them that really what is happening every time an advanced tax date comes is that the entire corporate sector and every individual is making a projection for the entire year, and this is the forward-looking statement that they are making through their payment of taxes. So when the tax collections are so robust, it is a conclusion for me without needing any other models that our economy is already on that trajectory. We are not just waiting anymore, it's already happening. The second set of metrics that I like to look at is energy consumption, power consumption, because that is to me a reflection of the real economy. Because while profits and taxes sometimes, particularly with the domination of the financial sector, can look somewhat different from what is happening at the ground level. But energy consumption, power consumption, when you look at that and you see that month on month on month, of course, adjusted for the cyclicality, we all know that in our country we have a cyclicality of power consumption, the trend line is again hugely positive. So to me, we are already well on our path towards this Viksit Bharat. And that, in fact, puts even more responsibility on each one of us who are part of the financial sector, particularly the sector where capital formation has to take place. From our side in SEBI, we think of capital formation as having two sides of the coin. One is creating the capital for industry to fuel growth. The second is wealth creation in the hands of the citizens of the country. So it's very important to us from an inclusion point of view that this growth which is happening in the country, the next decade which is going to be so wonderful for us, and the wealth that is going to get created, it also needs to go into the hands of the common person in the country, every citizen of the country. So the inclusion agenda is very, very important to us. And therefore, when there are large parts of the industry in our ecosystem, for instance, the mutual funds. Just the other day, I think the Birla Mutual Fund launched the 250 rupee SIP. Now, we've been working very closely with industry to make sure that that is something which is viable for them. It can be offered, but if it isn't viable, it will not get the traction. So I think the industry, AMFI, has really come forward. The leaders in the industry have come forward. And we are well on our way to making a 250 rupee SIP a reality in our country so that every person, no matter where and in which village, the cost of onboarding is low, the cost of servicing is low, technology is leveraged, and so that with that small amount of money, and people are really shocked globally when I say, roughly about $3 a month. And they're like, you can't even buy a Starbucks coffee with that. And I say, yes. So imagine with less than $3 a month, people will be able to participate in the wealth creation of our nation. And that is something we really look forward to. on our path towards a Viksit Bharat. So if we were to look forward and say, what will the market ecosystem look like going forward, and therefore what is it that the regulation must look like going forward? And what should be the process by which the regulator operates going forward? So the first and most important piece is tomorrow is going to be about a larger and larger scale, because that's the strength of our country, and that is what we want to leverage, that's what we want to drive, and that's what's going to become a reality. So in response to, and not just in response, in order to fuel this scale as well, the response and the expectation that the regulator will have, both from itself and from industry, is the deployment of technology. It has already started happening. Very, very large parts of our market ecosystem are now absolutely pioneering and leading edge in terms of technology globally. There is no other place on this globe where a lot of the technology that we have today in our country is actually present anywhere else. So whether it is the market ecosystem or whether it is SEBI itself, the adoption of technology in order to be able to manage effectively the scale that we are going to reach is a no-brainer. The second aspect or second dimension that is going to drive the market ecosystem is complexity. Already we are seeing the variety of asset classes, the variety of products, the variety of participants. You know, I often laugh that the number of different and distinct stakeholders that SEBI deals with is just growing and growing and growing. So as was referred that, we constituted this ease of doing business working groups, and we found that to actually address our stakeholders, we needed 16 of them. I'm sure by next year we'll need some 20 of them. So the complexity of what is happening in the market ecosystem is being driven by one important factor which we strongly endorse, which is the right product for the right person. So gone are the days where we say, boss, we have only these 2 or 3 asset classes, now you pick what you like. No. When we have the needs of such a vast variety and varied set of stakeholders, at that time it is incumbent upon us as a regulator to facilitate completely new products and new asset classes all the time to serve those needs, not in a simplistic one-size-fits-all manner, but because we have technology on our side, to be able to create a very large number of products and services which suit the needs of each segment in its own suitable way. So complexity is going to happen. Now the question is, how do we as a regulator expect to deal with it? And we expect to deal with it with co-creation with industry. Because we are very clear that with this increasing complexity, there is no way that the regulator sitting in its own little ivory tower can ever imagine, forget about, appreciate, and respond to all the complexity in the market. So there is no other way of doing the regulatory business other than to co-create. So this is not out of any magnanimity of the regulator. This is out of sheer necessity, because there is no way that without adequate consultation and co-creation, the regulator can come up with sensible rules, regulations, products, and services which will actually serve the market. So this concept of co-creation will only go further. As has been discussed, apart from our advisory committees, the Industry Standards Forum has been a very important initiative which we are now in the process of formalizing as a part of the regulatory architecture in SEBI. We found it extremely effective. And I can assure you that, many, many new steps will be taken. Single filing with the exchanges is going to become a reality very soon, if Ashish is here, but it's happening. It's work in progress. If you file your filings, your disclosures with one exchange, it will automatically go and populate on the websites of the other exchanges. So this is all simple stuff that technology will enable. Of course, there was a mention of REITs, but Ajkal, if I utter the word REITs, I am accused of conflict of interest. So perhaps it would be better for me to abstain. But indeed, these are the emerging asset classes in our country. Globally, they are large, strong. They monetize a lot of the build out of the infrastructure of the country. They have a huge multiplier effect in terms of the growth of the country. So all of this is very much on our agenda, and it will be done in a manner of co-creation, because that's the only sensible way to do it. The third thing that we believe is going to characterize our markets is speed. And the reason is not that it will characterize only our markets, it's because that's how the world is moving today. Today, even an overnight delivery of something you order online feels far too late, right? You want it in 15 minutes, right? And it happens. And then your expectation is, now why not 5 minutes? And now why not 2 minutes? And that is with physical goods. So you can imagine in the digital world, where is the expectation of people in terms of with what speed things should happen? So there is a certain speed which is all prevailing in the entire, not just market ecosystem, but the overall, I would say, the planet. And therefore, we too need to be able to, as a regulator, respond to that. So we believe that the way in which to deal with that is really to have focus. And what do I mean by focus? In order to have speed, you need to have clarity of thinking, right? Decisions are made quickly if you are clear on your objective, what you're trying to achieve, what you're trying to protect the investor from. And that clarity comes from a very sharp focus on what is it that is the fundamental requirement of the regulator to do. So within SEBI, we have restructured ourselves. We undertook a reorganization where we restructured ourselves in order to bring focus to certain specific activities, so that it is not a question of everybody trying to do everything and then it taking a long time, but a very focused and clear set of policies, processes, protocols, etc., in order to bring that focus, in order to bring that clarity, and therefore to facilitate speed. The next important thing is this whole question of inclusion, which I referred to earlier, that a Viksit Bharat with economic prosperity is still not a Viksit Bharat unless you have inclusion and participation. And this inclusion is not just about gender inclusion, not just about socio-economic inclusion, it is also about language inclusion and on so many other dimensions. We're very fortunate that we are on that cusp where, with the help of AI, language barriers should be a thing of the past. So as we think about how our regulations will evolve in the future, we will need to move well past saying simply, let's simplify the English in our regulation. We will need to move past that and say, why do we not have regulation? Why do we not have documents? Why do we not have IPO summaries in 15 languages or 27 languages? So a part of that inclusion agenda is to make sure that there is no barrier to people being informed investors and therefore being able to participate in the entire market ecosystem. Because without a sense of familiarity, the fear is far too much. The other day I met a person who runs an NGO in rural India, and it's a women's organization, and the only thing they do for women empowerment is to take a mock ATM, village to village to village to village, and teach the women how to operate the ATM so that they're not frightened of it, so that they take charge of their own Jan Dhan account and are not reliant on the men in the family, and they have control over their own resources. It's as simple as that. And you cannot imagine when she spoke the power of that, of just eliminating the fear that a woman has to go to an ATM and operate it, and how that fear stops her from participating and losing control over her own money. So to us, the inclusion agenda is very large, and it starts from saying that in what language, in what medium, through what channel are we being able to communicate everything that a person needs in order to be able to participate in the growth of the country. So this is going to be an important driver for us going forward. Of course, equally, from an inclusion agenda point of view, unless the cost comes down, inclusion cannot be a reality, because we cannot force the market ecosystem to sell a product that is fundamentally unviable, which is why we have taken so much of time and trouble to actually make the 250 rupee SIP viable, because if it's not viable, it simply won't fly, and we need it to just fly off the shelves. So the focus on cost, the focus on ensuring that economies of scale are passed on to the investors is an essential part of driving the inclusion agenda. With all of this put together, the final goal that we have, all of us sitting in this room, is the same, which is that for that Viksit Bharat, what is it that we as a country bring together to the table in order to facilitate that capital formation and wealth creation happens in a seamless, efficient, low cost, and highly inclusive way. Thank you.
Thank you, Madhaviji. As always, instead of talking at 30,000 feet, you are at the ground level telling us what's a particular roadmap. Starting with, if we have to move towards Viksit Bharat, it's a question of not only how do we get more prosperous, but how do we spread that prosperity through participation, through inclusion. We've talked about ensuring the right social infrastructure, focusing on sustainability, and very interestingly, the sachetization on products, talking about the 250 rupee SIP as well. Also, the importance of capital formation, which is both about, as a SEBI, making sure that there is access to capital, but it also results in wealth creation, and wealth creation for all, so that we can involve everybody in our growth in the coming decades. You also very clearly put a responsibility and an opportunity for growth, talking about right product for the right customer and the importance of that, as also the importance of speed, which has become a bit of a drug really for all of us from the Amazons and Flipkarts of the world. But yes, speed creates efficiency, it creates availability, it has its own benefit as long as it's not done in a rash manner. And finally, the importance of inclusion. And very interestingly, you touched upon the fact that today one language can create multiple languages, and we are already seeing examples of Gen AI that many of us are using that's enabling us to do that, which means that if we have to create wealth, we have to ensure that the greater financial literacy awareness that exists for the common man, each of whom, man and woman, are investors. How do they become informed investors? And interestingly, access to them through multiple mediums, multiple channels, multiple languages, really with technology becomes really using one language, one medium, one channel. So one is becoming many and many is becoming one, because that's what technology is enabling us to do. And I thought that was a very interesting and powerful thought. All in all, very clear pathways on, at least from your point of view, how you think the opportunity needs to be harnessed, the opportunity for India as we move towards Viksit Bharat by 2047, if not earlier. So let me just take the opportunity to thank you once again for taking us through your thoughts on this.
Thank you all for the enriching experience, inspiring us to surge ahead. Request you to please come together for a group picture that will stay with us for times to come. So, ladies and gentlemen, with that, we break for lunch that has been arranged in the adjoining foyer. I have a few announcements to make before you part. So we will reassemble at 2 o'clock for the next session. I want to apprise you that there will be a changeover in the room. I repeat, there will be a changeover in the room. So you are requested to please carry your belongings along with you when you move out of this room for lunch. Please carry your belongings along with you when you move out for lunch. Also note that the day will end with high tea, wherein you can network with your peers from the sector and counterparts from other organizations. We begin tomorrow with a networking breakfast in the morning from 8:30 to 9:15. The first session tomorrow begins at 9:30 sharp. Please be in your seats a little before that. Tomorrow we have the chairperson of IFSCA, Deputy Governor of RBI, Member IRDAI, Chairman PFRDA, whole-time member SEBI, and finally Secretary DEA will be joining for the valedictory. So we promise you a full day of new and significant learnings as we will get to hear directly from senior government officials and regulators themselves. We have a lot of ground to cover today and tomorrow. So tomorrow will be an early start, and today we begin the post-lunch session exactly as per schedule. So please be in your seats by 2 o'clock, which will enable us to have sufficient time for all the sessions. I remind you again, as you move out for lunch, please carry your belongings along with you as we will be having a changeover of the seating arrangement in this ballroom. Thank you.
वाह, ओपनिंग अ बिजनेस करंट अकाउंट।
ये क्या वाह, पहले अकाउंट खोलो, फिर पीओएस के लिए अप्लाई करो और फिर क्यूआर। पता नहीं कब मिलेगा ये सब।
मुझे तो सब इंस्टेंटली मिल गया।
सीरियसली?
सीरियसली, तू जानता है इसका बैंक कौन है?
कौन है?
SBI। SBI देता है बिजनेस करंट अकाउंट के साथ पीओएस और क्यूआर कोड। इसे कहते हैं सॉलिड बैंक, ये सॉलिड बैंकिंग।